Hello everyone, welcome to the 62nd episode of me learning how to trade in Forex. So in the last video we went through how to use moving average envelopes, basically setting upper and lower bounds for your moving average, and how to calculate it. Oh well, I think the software does it for you, but it's just like a upper and lower range, as I've said. And then confirming trend directions, so when to buy, when to sell, and I'd also identify overbought and oversold levels with the moving average envelopes. So in this video we're going to go through how to analyze trends with moving average ribbons. So let's get started with what's it called again? How to analyze trends with moving average envelopes. Oh, moving average ribbons. Nice. Date is second. Right, what is a moving average ribbon? A moving average ribbon is a series of moving averages of different lengths plotted on a chart. Moving average ribbon is a series of moving averages of different lengths plotted on a chart. The basic idea behind the concept of moving average ribbons is that instead of using one or two moving averages on a chart, you are using a bunch of moving averages, usually between 6 to 16 moving averages. Whoa. Series, usually 6 to 16. There's a series all on the same chart. Let's take a look at an example. So this is a moving average ribbon. You can see there's loads of moving averages going on. Traders can determine the strength of a trend by looking at the smoothness of the ribbon, as well as identifying key areas of support or resistance by looking at the price in relation to the ribbon. Strength of the trend can be determined by looking at the smoothness of the ribbon. By ribbon, do they mean like all of the ribbon or just like one? As well as identify key areas for support or resistance while looking at the price in relation to the ribbon. Key areas of support and resistance can be identified by looking at the price in relation to the ribbon. How to set up a moving average ribbon. A common question is, how many moving averages do I use? It really depends on the trader. Some traders like to use 6 to 8 simple moving averages set at a 10-period interval, such as the 10, 20, 30, 40, 50 and 60-day simple moving averages. Other traders like to set up with 16 or more simple moving averages, varying from a 50-day to a 200-day simple moving average, and everything in between. The argument for using longer term moving averages is that it gives a more accurate look at the overall trend. Then other traders like to use exponential moving averages instead of simple moving averages. So it's a really matter of preference. The responsiveness of the moving average ribbon can be adjusted by changing the number of time periods used in the moving average, changing the type of moving averages from a simple moving average to an exponential moving average. So responsiveness of the moving average ribbon can be adjusted by changing the number of time periods used in the moving average and changing the type of moving average from a simple moving average to an exponential moving average. The shorter the number of periods used when selecting which moving averages to add to your chart, the more sensitive the moving average ribbon is to slight price changes. The shorter the number of periods used when selecting moving averages, which moving averages to add to the chart, the more sensitive the moving average ribbon is to slight price changes. Using moving averages of a large number of periods like 200 are less sensitive and smoother. How to trade with moving average ribbons. An expanding moving average ribbon signals the potential end of a trend. An expanding moving average ribbon signals the potential end of the trend. An expanding moving average ribbon signals the potential end of a trend. When the moving averages start widening out and separating, also known as ribbon expansion, so widening out, separating as in like that one goes that way, that one goes that way, so like they're less closed up together, bunched up together. This signals that the recent price direction has reached an extreme and could be the end of a trend. When the moving averages start widening out and separating, known as ribbon expansion, this signals that recent price direction has reached an extreme and could be the end of a trend. Think of each moving average as a magnet and they're attached to each other. They do not want to be too far apart from each other for too long, so when they are, they will want to close that distance. A contradicting moving average ribbon signals a possible change in trend. When the moving averages start to converge and get closer to each other, also known as ribbon contraction, a trend change has possibly started. So when the moving averages start converging and converging to get closer to each other, known as ribbon contraction, this signals that a trend change has possibly started. After an extreme move in price in one direction, you will notice shorter term moving averages converge first. The longer term moving averages will slowly converge. because the shorter term ones are like more sensitive to, I guess, price changes, because it's shorter time periods, isn't it? So shorter time period ribbons will converge first, then longer time period ribbons. A parallel moving average ribbon signals a strong trend. A parallel moving average ribbon signals a strong trend. When the moving average ribbons are parallel and evenly spaced, this means that the current trend is strong. So when the moving average ribbons are parallel and evenly spaced, this means that the current trend is strong. All the moving averages are in agreement since they are moving together. All the moving averages are in agreement since they're moving together. Keep an eye on the spacing between the moving averages. Keep an eye on the spacing between the moving averages. Some traders make the mistake of only paying attention when the moving averages cross over or twist. Whilst it is important to monitor when the short-term moving averages cross above or below the long-term moving averages, it's also important to monitor the spacing between the moving averages. On the spacing between the moving averages. So we'll say monitor the spacing between the moving averages. The positioning of short-term moving averages relative to long-term moving average shows the direction of the trend. The positioning of the short-term moving average relative to the long-term moving averages shows the direction of the trend. E.G. up, down, sideways. The spacing between the moving averages shows the strength of the trend, weak, neutral, strong. The spacing between the moving averages shows the strength of the trend. Weak, neutral, strong. So the less spacing there is, the stronger the trend, right? Because they're all huddled up together, so they all like basically confirm each other. Whereas if they're really far apart, then they all got different opinions between each other, so I guess the trend isn't really like confirmed, if that makes sense. So if the long term and the short term ones are really far apart from each other, then what the short term is saying is probably different to what the long term is saying, or what the long term trend is like is probably different from what the shorter term trend is like. So yeah. Okay, so Moving average ribbon example. Let's take a look at the moving average ribbon applied to a GBP USD on a 1 hour chart. So we got the chart here. Can you see the trend changes? Parallel moving averages indicate strong trend, yeah, because they're all pretty much going down the same way. Ribbon expansion indicates potential end of the trend, so we can see that they're all spacing between them starting to grow further apart. Ribbon contraction indicates a possible start of a new trend, so they all come back closer together again, and then this is a downtrend, this is uptrend, so the new trend is coming, or started, or happened actually. In the chart above, you can easily identify bullish or bearish trends by looking at when the moving averages start to cross over or twist lower or higher. Ribbon expansion of the widening of the spacing between the moving averages suggests the end of a current trend. Ribbon contraction or the narrowing of spacing between the moving averages suggests the start of a new trend. How to trend trade with Guppy Multiple Moving Average. So, how to trend trade with Guppy Multiple Moving Average. The Guppy Multiple Moving Average indicator provides an interesting approach using moving average ribbons. As a trend trader, it's not enough to just identify the direction of a trend and catch the trends. Trend trading success depends not only properly identifying the trend direction and catching the trend after it has started, but also on getting out as soon as possible after the trend is reversed. If you find yourself struggling with any of the above, you may want to look at the Guppy Multiple Moving Average indicator. The Guppy Multiple Moving Average, also simply known as Guppy, is a technical indicator that identifies changes in trends, which means it provides you with an objective method to know when to get in and when to get out of a trade. The Guppy Multiple Moving Average is a technical indicator which identifies changes in trends, providing the trader with an objective method to know when to get in and when to get out of a trade. On the chart, it looks like this. Red, blue lines, okay. The Guppy was created by an Australian trader named Darryl Guppy, hence the name of the indicator. Don't confuse Guppy, the indicator, with Guppy, the nickname for GBP JPY. They are two different things. This means that you can trade the Guppy currency pair using the Guppy indicator. Laughing emoji. Darryl introduced GMMA in his book Trend Trading. The Guppy is a trend following technique composed of 12 exponential moving averages or exponential moving averages. The Guppy is a trend following technique composed of 12 exponential moving averages. The multiple lines of the Guppy helps traders to see the strength and weakness or weakness in a trend better than if only using one or two exponential moving averages. The 12 exponential moving averages are separated into two groups: a short-term group of exponential moving averages, a long-term group of exponential moving averages. 12 exponential moving averages split into two groups: a short-term group of exponential moving averages and a long-term group of exponential moving averages. Each group contains 6 moving averages, 6 short-term group and 6 long-term group of exponential moving averages. Okay, so short-term group you can see by the blue, and the long-term you can see by the red. There's a crossover here, so I'm assuming that's when you start trading. And then there's these spikes of the short term. Okay. In the chart above, the two groups of exponential moving averages are differentiated by color. Short-term group is blue, whilst the long-term group is red. The trend is determined by the long-term exponential moving averages. Signals are given by the short-term exponential moving averages. So trend is determined using the long-term exponential moving averages. Signals are given by the short-term exponential moving averages. You would enter a trade when a trend reversal occurs, which is indicated when one group crosses over the other group. Okay, enter a trade when a trend reversal occurs, which is indicated when one group crosses over the other group. When a short-term group crosses above the longer-term group by. When a short-term group crosses above the long-term group by. When a short-term group crosses below the long-term group, sell. When the short-term group crosses above the long-term group buy, below, sell. How to set up the Guppy Multiple Moving Average. This technique consists of combining two groups of exponential moving averages with differing time periods or length. The 12 period used are 3, 5, 8, 10, 12, 15, 30, 35, 40, 45, 50 and 60. So 3, 5, 8, 10, 12 and 15 exponential moving average time periods are used to show the short-term trends momentum. $30, $35, 40, 45, 50 and 60 exponential moving average time periods are used to show the long-term trends momentum. So short terms here, you can see long terms, that one there. Now let's show both groups of exponential moving averages on the chart. Yep. Trend reversals and continuations can be identified with these two groups of exponential moving averages. Trend continuation, trend reversals and continuations can be identified with these two groups of exponential moving averages. Whoops. Go here. How to use the Guppy Multiple Moving Average. The Guppy Multiple Moving Average can be used to identify changes in trends, direction, or gauge the strength of the current trend. The Guppy can be used to identify changes in a trend, direction, or gauge the strength of the current trend. How to identify trend strength? The degree of separation between the short and long-term moving averages can be used as an indicator of trend strength. The degree of separation between the short, also the gap between them. So the degree of separation between the short and long-term moving averages can be used as an indicator of trend strength. Narrow separation between the two groups of EMAs, I'm assuming that means a strong strength. Wide separation, that means a weaker strength. If there's a wide separation, this indicates that prevailing trend is strong. Oh, never mind. If there's a narrow separation with lines that intertwine, this indicates weakening trend or period constellation. Never mind then. Completely opposite to what I said. So wide separation indicates the prevailing trend is strong. Narrow separation indicates narrow separation or lines which intertwine a weakening trend or a period of consolidation. How to identify trend reversals? The crossover of the short and long-term moving averages represent trend reversals of crossover of the short and long-term moving averages represent trend reversals. So bearish reversal, short-term exponential moving averages crosses below the long-term moving exponential moving averages. Bullish reversal is when short-term exponential moving averages crosses above long-term exponential moving averages. So hence, I think we wrote before, it was like something about buying and selling. So when the short-term crosses above the long-term, buy, so that's a bull. When the short-term crosses below, bearish, short-term crosses below, that means it's a sell because it's a bearish. Okay, so if the short term crosses above, this is known as bullish crossover, indicate a bullish reversal has occurred. How to identify a lack of trend? When the moving averages between the two groups are close together and approximately parallel, this indicates that the short term market sentiment and long term trend are largely in agreement. When the moving averages between the two groups are close together and approximately parallel. See, when they say approximately parallel, do they mean flat or parallel as in like because this is kind of parallel, isn't it? Well, it's not close together, but like but they're traveling in like the same horizontal axes kinda, as in like they're both traveling along like this sort of line here. So well, I guess that's not parallel really, that's going, yeah, see, like parallel is like these two lines, right? They're parallel because they're still traveling in the same like direction, so they're still parallel. But I think parallel when they write here is like they have to be like flat basically. So and approximately parallel, I want to write flat here, I'm just gonna write flat here. It indicates that the short term market sentiment and long term trend are largely in agreement. Basically, when both groups of EMAs are moving horizontally, oh here we go, horizontally, or mostly moving sideways are heavily intertwined, are close together and approximately parallel. Close together, moving sideways, approximately flat. It means the price lacks a trend. Meaning price lacks a trend. So you can see it's a bit flat here, so no trend. Looking at the chart above, notice how when the red and blue group of exponential moving averages are intertwined, price is directionless, simply moving up or down within a range. This current price action is more suitable for range trading. As a trend trader, it would make sense to sit out and wait for better conditions. Just remember this phrase: when the market is sideways, trend traders sit on the sidelines. Range trading, I'm guessing that's when you buy here, you sell here, like you just do it within this range then. Maybe. How to trade currencies with the Guppy Multiple Moving Average. The Guppy Multiple Moving Average indicator can be used for trade signals, buy signal. When all short-term exponential moving average cross above all long exponential moving average, a new bullish trend is confirmed and triggers a buy signal. So when all short exponential moving average crosses above all long Wait, we wrote this before, so haven't we? Short-term crosses above the long. Confirms a buy signal. Buy. Okay, we wrote this. Sorry. During a strong uptrend, when a short-term moving average moves back toward the long-term moving averages, but do not cross. Okay, this is interesting. So, when all short-term crosses above all long-term exponential moving averages, a new bullish trend is confirmed and triggers a buy at this. During a strong uptrend, when the short term exponential moving averages move back towards the long term exponential moving averages, but do not cross, and then moves back higher, this signals another continuation of the bullish trend and triggers a buy signal. So, when a strong short-term exponential moving average, which is the blue one, moves back toward the long-term one, so here, but do not cross, so it doesn't cross here, and then start moving back up higher, this signals another continuation of bullish signal and triggers a buy signal. Okay, so buy signal, all short-term exponential moving averages cross above the long-term ones, yep. Short-term exponential moving averages turn lower toward the long-term, so we can see a little dip here, but do not cross, then turn higher again, so this is another bullish trend. Also, after crossover, if prices fall back and then bounces off from the long-term exponential moving averages, this signals a continuation of the bullish trend and triggers a buy signal. After a crossover, if prices fall back and then bounces off from the longer term exponential moving averages, this signals a continuation of the bullish trend buy at here as well. Sell signals. When all short-term exponential moving averages crosses below all long-term exponential moving averages, a new bearish trend is confirmed. Sell at this. During a, sell signal, yep. During a strong downtrend, when the short-term exponential moving averages move back towards the long-term exponential moving averages, but do not cross, and then moves lower, this signals another continuation of the bearish trend and triggers a sell signal. After a crossover, if prices rises and then bounces off from the long-term exponential moving averages, this signals a continuation of the bearish trend. Sell at here as well. No signal. The buy and sell signals above should be avoided when the price and the exponential moving averages are moving sideways. Buy and sell signals should be avoided when the price and exponential moving averages are moving sideways. So moving sideways or flat, following a consolidation period, wait for a crossover and separation. Following a consolidation period, wait for a crossover and separation. If there is no trend, this indicator will not work. There is no trend, this indicator will not work, aka the Guppy indicator will not work if there's no trend. Guppy moving average, was it Guppy multiple moving average, isn't it? Guppy multiple moving average, yeah. Guppy multiple moving average compression breakout strategy. The moving averages also act as support resistance levels. So moving averages also act as support and resistance levels. When compression of both groups of moving averages occurs on the same candlestick, this could indicate an overall trend change. So when compression of both groups of moving averages occur on the same candlestick, this could indicate an overall trend change. So when compression of the both groups of moving averages occurs on the same candlestick, this could indicate an overall trend change. Here's the setup. Look for a candlestick in which the high and low pierce through all 12 moving averages. Place a buy or stop order above the high and sell stop order below the low of the candlestick. Once filled, make the opposite stop order that wasn't filled your initial stop loss level. So either the high or the low, or high or the low. Trade or stop at the prior candlestick low, candlestick's low if long or high if short until stopped out of position. Compression breakout strategy. Yeah, you know what? I think I'm going to leave this episode here because this is probably should be in its own little lesson, you know, but Yeah, I need some time to read this and figure this out. Not in this lesson. So I'm gonna leave this episode here. So thank you guys for watching. In the next video, we're going to be carry on with the same lesson, but with the Guppy Multiple Moving Average compression breakout strategy. So yeah, see you then. Peace.